Breaking news. The Bank of England has decided to keep the UK's main interest rate unchanged at 5.25% for the fifth meeting in a row. This move comes at a critical moment for the British economy, as policymakers weigh the risks of persistent inflation against the growing pressures on households and businesses. The decision, announced early this morning, signals a cautious approach as the bank tries to navigate a complex economic landscape. The announcement also reveals deep divisions within the bank's Monetary Policy Committee, the group responsible for setting rates. Some members argued for a cut to support growth, while others insisted on holding firm to prevent inflation from flaring up again. This was far from a unanimous decision. The vote was tense and closely contested, reflecting the uncertainty and anxiety about the UK's economic future. The split highlights just how difficult it is to strike the right balance between fighting inflation and supporting a fragile recovery. High interest rates have played a key role in bringing down inflation from its recent peaks. The bank's aggressive rate hikes over the past 2 years have helped cool price rises, offering some relief to consumers. But these same high rates are now taking a toll. Households are struggling with higher mortgage payments, and many small businesses are finding it harder to borrow and invest. The cost of living remains a major concern for millions across the country. The bank's message today is clear. While progress has been made in the fight against inflation, the job isn't finished yet. Officials warn that cutting rates too soon could undo the hard-won gains of the past year. The risk of inflation returning remains significant, especially with global energy prices and supply chains still unpredictable. For now, the bank believes it's safer to wait and watch rather than risk a premature move. For homeowners with variable rate mortgages or those looking to remortgage, this means continued high monthly payments. The dream of lower borrowing costs remains just out of reach for many families. Across the country, people are feeling the squeeze as they try to balance household budgets and plan for the future. The uncertainty is making it harder for families to make big financial decisions. On the other hand, savers are seeing better returns on their deposits, a rare silver lining in an otherwise challenging environment. For those with money in the bank, higher rates mean more interest earned. Ultimately, the Bank of England is choosing caution over risk, determined not to let inflation spiral out of control again. Officials stress that patience is needed to ensure the recovery is sustainable. The bigger picture is sobering. The UK economy remains stuck in a low-growth holding pattern. Activity is subdued, and many businesses are waiting for clearer signals before investing or hiring. As policymakers debate the next steps, the focus remains on making sure inflation is truly under control before any move to lower rates. For now, the standoff continues, with the bank watching the data and the nation closely. The vote was razor-thin, a decision that could sway the economic future of the nation. 5 members stood firm for holding rates steady, while 4 advocated for a cut, highlighting a deep divide. This near-even split signals just how uncertain the economic outlook is, and how close the bank is to changing course. The tension in the air is palpable, as each decision carries significant weight. The dissenters argue the economy has cooled enough, and that high rates now risk pushing the UK into recession. They believe a rate cut could provide much-needed relief to struggling sectors. The majority, however, fear inflation could flare up if they move too soon. They worry that premature action might undo the progress made in stabilizing prices. This division means future decisions are on a knife edge, with the next batch of data potentially tipping the balance. Every economic indicator is scrutinized, as the stakes are incredibly high. The debate is fierce, and markets are watching every signal for clues about what's next. Investors and analysts are on high alert, trying to predict the bank's next move. If the economy weakens or inflation drops further, a rate cut could come as soon as the next meeting. This possibility keeps everyone on edge, as the implications are vast. For now, uncertainty reigns, making it tough for businesses and families to plan ahead. The unpredictability of the situation leaves many in a state of limbo, waiting for clarity. Inflation is at the heart of the bank's dilemma. The official rate has dropped to 2.8%, a huge improvement from the double digits of 2023, but services inflation and wage growth remain stubbornly high. Services inflation, closely tied to wage growth, is still above 4%, raising fears that domestic price pressures could reignite. Wages are rising around 5% annually, which, while good for workers, risks fueling a wage price spiral. The bank wants to see both wage growth and services inflation cool before cutting rates. Policymakers are poring over every jobs report, looking for signs of a sustainable slowdown without a spike in unemployment. Until there's clear evidence of easing pressures, the majority will remain cautious. The fight against inflation isn't over yet. The Bank of England is walking a tightrope between fighting inflation and avoiding recession. High rates risk choking off growth, raising unemployment, and pushing the UK into stagnation. But cutting rates too soon could reignite inflation, forcing even harsher measures later. The UK economy has barely grown in the past year, with some sectors already contracting. Doves argue the damage from high rates is mounting, and cuts are needed to avoid a deeper downturn. Hawks warn that sticky wage growth and global risks mean it's too soon to ease up. The 5-4 split reflects this fundamental disagreement. For now, the bank is erring on the side of caution, waiting for clearer signals. Deep within the historic walls of the Bank of England, a timeless and high-stakes debate is unfolding, a debate that will have far-reaching consequences for every corner of the UK economy. This is the classic battle between the so-called hawks and doves, two camps of policymakers and economists with sharply contrasting views on how to steer the nation through turbulent economic waters. The hawks, ever vigilant, argue that interest rates must remain high until inflation is not just tamed but thoroughly defeated. They believe that only by taking a tough stance now can the country avoid even greater pain in the future. For them, the priority is long-term stability, even if it means enduring some short-term hardship. They see this as a necessary sacrifice to protect the value of the pound and the financial security of households. Their case is bolstered by data showing persistent wage growth and stubbornly high services inflation. These indicators, they warn, could reignite price pressures if the bank lets its guard down too soon. The hawks insist that patience and resolve are needed to ensure inflation doesn't spiral out of control again. On the other side, the doves see a different set of dangers. They point to a stagnating economy, rising business failures, and growing signs of distress among small firms and households. For them, keeping rates too high for too long risks tipping the country into a needless and damaging recession. The doves argue that inflation is already on a downward path, and that the full impact of previous rate hikes has yet to be fully felt across the economy. They caution that acting too aggressively now could choke off growth just as the recovery is beginning to take hold. Both sides present compelling arguments, each backed by data and deeply held convictions. This ongoing tension is what makes the Bank of England's job so challenging, balancing the risks of runaway inflation against the dangers of economic stagnation. The outcome of this debate will shape the UK's economic path for months and possibly years to come. Every decision made in these rooms will ripple outwards, affecting jobs, mortgages, and the cost of living for millions. For now, the hawks have a slight upper hand, but the balance could shift at any moment. The debate is far from over and the stakes could not be higher. The bank's decision hits home for millions of Britons. High rates mean mortgages, loans, and credit cards stay expensive, squeezing household budgets. Homeowners on variable or expiring fixed-rate deals face higher monthly payments, sometimes hundreds of pounds more. Savers, however, benefit from the best returns in years, especially retirees relying on interest income. The same policy that helps savers hurts borrowers, creating a deep divide. High rates also cool the job market, as businesses cut back on hiring or even make redundancies. Unemployment remains low for now, but job vacancies are falling, a sign of growing strain. The bank is trying to tame inflation without triggering a wave of job losses, a delicate balancing act. The UK economy depends on consumer confidence and spending. Years of high inflation and rising costs have left households cautious, with retail sales sluggish and big purchases on hold. This caution helps cool inflation, but risks tipping the economy into stagnation. Meanwhile, wage growth is finally outpacing inflation, giving people more real spending power. The big question: will households save this extra cash or spend it, potentially reigniting inflation? The bank is watching savings rates, credit card spending, and retail sales for clues. If consumers start spending more, inflation could stay stubbornly high. For now, uncertainty about consumer behavior keeps the bank on high alert. The Bank of England may be independent, but government tax and spending decisions, fiscal policy, can make its job much harder or easier. A big spending budget could boost demand and force the bank to keep rates high, while a tight budget could help bring inflation down faster. With the autumn statement looming, the bank is waiting to see if the government will press the accelerator or the brake. If fiscal policy loosens, the bank may have to hold or even raise rates longer. If the government tightens, rate cuts could come sooner. The interplay between monetary and fiscal policy is crucial and adds another layer of uncertainty. For now, the bank is keeping its options open, watching for signals from Westminster. The bank's split decision leaves the UK at a crossroads. If inflation and wage growth cool further, a soft landing is possible, rate cuts could begin, and the economy might avoid recession. But if inflation proves sticky, high rates could persist, risking a downturn and rising unemployment. The most likely scenario is a bumpy road ahead, with the bank moving cautiously and data driving every decision. For families and businesses, this means continued uncertainty and the need to budget for high borrowing costs. The key indicators: monthly inflation and jobs reports. A decisive shift in either could trigger the bank's next move. The UK's economic path now hangs on the numbers and the bank's next call.